The vast majority of taxpayers operate within a simple, brutal contract with the Internal Revenue Service. You earn income, you sell an asset for a profit, and you pay tax on the resulting realized gain. That is the foundation of the public tax consciousness. Yet some of the wealthiest individuals in the world, the 0.01%, routinely report virtually zero taxable income and pay near zero taxes, even as their net worth expands by billions annually. This is not an accident of market timing. It is a calculated, engineered function of the tax code. It is the core paradox of modern wealth accumulation. How do the ultra-rich live like kings, funding their extravagant lifestyles without ever selling their core assets or generating the traditional income necessary to pay for it? The answer lies in the masterful manipulation of one critical concept: unrealized gains. The term income for the middle class means a paycheck. For the 0.01%, income is an illusion to be avoided. Their wealth is not held in cash, but in concentrated stock positions, often in the company they founded. These holdings appreciate rapidly. The growth, the billions in profit, is called an unrealized gain. The key word is unrealized. The black box of tax strategy is built upon this single exemption. Under current U.S. law, appreciation in asset value is not taxed until the asset is sold. If you never sell, you never have a taxable event. This black box provides the crucial operating principle: buy, borrow, die. Think of this mechanism using a universal analogy. Imagine a massive, priceless reservoir of pure water. The average taxpayer must drain their drinking cup from the reservoir and pay a tax every time they refill it. The billionaire, however, has a specialized filtration system that allows them to draw out a consistent flow of fresh, usable capital from the pressure of the water itself without ever touching the principal reservoir. The water level remains high, the pressure is constant, and the tap runs free. They are living off the pressure, not the depletion. That pressure is their unrealized gains. The billionaire lifestyle is financed not by the sale of assets, but by the strategic collateralization of those assets. This is the mechanism, the intricate plumbing that bypasses the traditional tax stream. The billionaire begins with a massive, highly appreciated stock portfolio. This is the collateral. Crucially, they have a very low cost basis, the original price paid for the asset. If they were to sell, the difference between the sale price and the cost basis would be the realized gain, triggering a capital gains tax of up to 23.8%. Their goal is total avoidance of this. Instead of selling, the billionaire approaches a private bank or a major financial institution. They pledge a fraction of their highly valued stock, say 10%, as collateral for a non-recourse line of credit, known as a securities-based loan or a portfolio margin loan. This is a crucial pivot point. The bank is not lending based on the borrower's taxable income. They are lending based on the collateral's liquidation value. The resulting cash infusion is, by definition, a loan. Under tax law, a loan is not income. It is a debt obligation. Therefore, the billions drawn from this credit line are completely non-taxable. This loan provides the liquidity to buy homes, jets, super yachts, and fund daily life, all without generating a single dollar of conventional taxable income or triggering a realized gain. The true genius lies in the safety margin, the loan-to-value ratio. Since their assets often appreciate far faster than the market average, the risk of a margin call is inherently low. The asset's intrinsic value acts as a shield. This is the ultimate endgame, the die component of the buy, borrow, die strategy.
The billionaire continues this borrowing cycle, paying off old loans with new, larger loans, or occasionally with small dividends. They hold their core appreciated assets until death. When the billionaire dies, a critical and often overlooked provision of the U.S. tax code is activated: the step-up in basis. The cost basis of the inherited assets is reset or stepped up to the fair market value on the date of death. Consider an asset bought for $1 million that is now worth $1 billion. If the owner sold it, they would realize a $999 million gain. If the heir inherits it, their new cost basis is $1 billion. If they sell it the next day for $1 billion, their realized gain is zero. The $999 million in unrealized gains vanishes into the ether of the tax code, escaping capital gains taxation entirely. It is a complete legal obliteration of the tax liability. The debt used to fund the billionaire's lifestyle is often paid off by the estate with a small portion of the inherited asset, or simply assumed by the heir, still non-taxable. This mechanism is why the black box of unrealized gains operates as a generational wealth transfer tool,
the massive root system
not just
of the
a
mother
lifestyle
tree
subsidy.
Pumps vital energy directly into the sapling.
To understand the scale of this structural advantage, we must compare the billionaire's outcome with the path of a high-earning professional, the everyday taxpayer. Imagine a highly compensated engineer or doctor. They earn a $5 million salary and invest aggressively. That salary is immediately taxed at a rate of up to 37% federal plus state taxes. They are left with roughly $3 million to invest. If their investments appreciate by 10% and they need to withdraw capital for a down payment or to fund college tuition, they must sell, immediately triggering a capital gains tax on their realized gain. Their wealth is depleted with every transaction. They are always trading future appreciation for current liquidity, and they are always paying tax on the liquidity. Now, contrast this with the billionaire who has a $5 million loan and a negligible salary. The $5 million loan is not taxed. They have 100% of the value available. They get the liquidity they need without realizing a gain, without paying income tax, and without selling the underlying asset. They maintain their full exposure to the compounding appreciation of their core portfolio. The difference is not merely the immediate tax savings, it is the compounding effect. The billionaire's assets continue to grow unencumbered by a 23.8% capital gains tax. The total value of the tax liability avoided is perpetually reinvested. Over decades, this difference multiplies exponentially, ensuring that the gap between those who live off realized gains and those who live off strategic borrowing against unrealized gains widens into a chasm. This is the true power of the tax deferral mechanism. The system we have deconstructed is often painted as a complex series of loopholes, but to view it as merely a collection of isolated loopholes is to miss the architecture. The buy, borrow, die strategy is a feature, not a bug, of a tax code designed to incentivize investment and capital accumulation. It is the invisible contract that separates the asset-rich from the income-rich. When the world debates the tax burden of the ultra-wealthy, it is often focused on their income tax filings, which tell only half the story. The true fiscal event, the unrealized gain that powers their lives, remains entirely outside the scope of income taxation until death, where the step-up erases the debt to society. This forces us a fundamental question. Should a system that incentivizes the creation of generational wealth also contain a near-perfect mechanism for the complete and legal avoidance of capital gains taxation on that wealth? Is the step up in basis a necessary economic lubricant or the ultimate subsidy for the very wealthy? If you seek to understand the rules of the game at the highest level, the true mechanism by which wealth is preserved and magnified, then join us. Subscribe to the Billionaire Tax Strategy. The only way to truly understand a tax law is to follow the flow of capital. And with the 0.01%, the flow is always towards zero.